Thank you, Chris. Certainly, after the fireworks of 2016, making predictions has become a very precarious business. My job regularly is to stand up and make bold statements like the UK will not leave the European Union, and then be proved wrong by 17 million people in the biggest democratic mandate this country's seen for a long, long time. I'd make two defences, though. First of all, I did say it would be very, very close, edge of the seat stuff, and it certainly was, I think, and still is now, of course. But secondly, that if I'd stood up here and got the year exactly right, I suspect I wouldn't be standing here now. Just think about what your reaction would have been if I'd made exactly the predictions, the correct predictions for 2016. Although, if I put some money on it, I might not care about that at all. But what I will try and do is read the runes for our markets now. Whether it's the economy, what occupiers are thinking, what's happening in different sectors. I'll try and squeeze that into 15 minutes. I'll do my very best, but I can't guarantee that will happen. Probably a wise choice, given my recent record in predictions. One other area which we got very wrong was the immediate impact of the no vote. All those forecasts of doom and gloom brought about by Project Fear. None of it happened. Look where we've ended up. Leasing and investment volumes at around the 10-year average. Recent surveys from the manufacturing sectors, services sectors, construction sectors, showing activity at the highest since several months before Brexit, if not more. Very strong recent commitments to London, both from occupiers like Apple, Wells Fargo, but also from developers. Look at the go-ahead for 22 Bishopsgate, a game-changing scheme, a vertical city for London that would try and attract occupiers from right across the spectrum. All that, I think, is a really strong sign that London and the wider UK is still a force to be reckoned with in business. Given all that, perhaps the most important point is that the UK will end the year as the strongest performer in the G7 with growth at close to 2.0%. Given all that, we should probably ditch conversations about Brexit, but the one thing I think we can be sure of is that Brexit, Trump, perhaps events in Europe, will dominate conversations for the next few years. You can say what you like about Brexit, but it's certainly got people interested in politics again. I mean, the EU used to be boring. I was looking at surveys on what the UK thought was the most important issue facing the country. Go back to 2011, and the European Union is about 21st. Think about how things have changed in that time. People used to think it was a boring, irrelevant issue. And it will certainly get more relevant, I think, when negotiations begin in earnest after Article 50. We've seen a lot of momentum, I think, in our markets and the economy, and I suspect that will continue for the first half of the year. But when things start happening, I think things may get rather more interesting, as I said. The first thing that will land on the table of those negotiators will be a very big bill addressed to the UK taxpayer. That's going to set teeth on edge right across the spectrum, and it will also leave some interesting headlines in the tabloids. Secondly, think about what happened to the pound yesterday after some cryptic and I think fairly indecisive comments from May. And we saw quite a lot of interesting things happen in the currency market. If that happens in that context, think what will happen to the pound when negotiations begin in earnest. I'm not saying it will necessarily end the year at a lower point, but it will be a roller coaster ride. And at the same time, we've got the French, the German and Dutch elections. Lots of moving parts on the continent. I'm slightly more optimistic there. A brave point. You'll probably be laughing at me again this time next year. But I do think the status quo is probably more of an option there, partly because of the way the electoral systems work, but also look at where the polls are at the moment. I know they've failed us before, but Le Pen is, in a runoff, would still be beaten comfortably by the two leading candidates. And Merkel has slumped to a terrible 10% lead over her opposition. So I think that's probably not as likely to be an issue as we've heard before. I also think there's a bit of Eurosceptic bias here, of course. If one group has got predictions wrong, it's extreme Eurosceptics arguing year after year after year that the EU is about to fall apart. They've got a worse record, I think, on that than many people. But I do think the status quo is probably a more probable option. The EU will stay united on those four freedoms: goods, services, capital, and unfortunately for the UK negotiators, labour. I think that might change as we move into 2018, 2019. And I think if we move towards a point of crisis, which will affect the EU as well, I think a deal will be made. So I'm still confident on that, but I think the initial mood music might be quite tough. And that's why I think the second half could be more difficult. I do think that banks will take some space in places like Frankfurt and Dublin in particular, perhaps Paris as well. But I do think the actual numbers involved will be small, and that means there will not be a large amount of tenant space coming back to the market. So the effect in fundamental terms will be quite minimal, but I think the headlines could damage that confidence, which I think will definitely be held onto for the first half of the year, but could become more of an issue in the second half. So I certainly expect demand from the financial services industries to be somewhat weaker, or at least moving towards a more desire for more flexible space. And that will drag on certain markets where we have a lot of exposure to financial services. But on the other hand, tech, I think it will remain very, very robust as a source of demand over the year. We've seen headlines this morning saying that confidence in that sector has rebounded back to pre-Brexit highs. But I also think, looking at it long-term and strategically, London is a great place for tech, given the rhetoric on both sides of the Atlantic. The Trump team really don't seem to like Silicon Valley very much, mainly because they all vote Democrat or support the Democrats. But partly, I think, and mainly, he's more interested in those traditional industries that support the blue-collar base, which is his electoral route. And secondly, the EU has alienated that industry, I think, by rulings on privacy and data security and also on tax. So I think post-Brexit London is obviously a very good bet for the tech industries. And that will carry on, I think, supporting our industries over the year. And I would suggest that means that capital, assuming confidence remains high, that take-up in the capital will pretty much be in line with this year and may even exceed it, with last year rather, and may even exceed it. Having said that, occupiers will be dealing with uncertainty. That's the main theme of the year for them. That will be a boon for the flexible space providers we've seen become such a big presence in the London market over the last few years. And it will also mean that landlords have to adopt a more flexible approach to leases. And that's happening anyway. It's just accelerating these processes, which I think is one of the big themes of Brexit. They'll also be keeping an eye on costs, with business rates due to go up significantly over the next few years. It's those markets that have been so popular with occupiers, King's Cross, Fitzrovia, Shoreditch, that will see the biggest increases because they've seen the fastest increase in rents. They offer exactly the combination of authenticity, great amenities, placemaking, great buildings that occupiers are looking for. But I do think that these are also the markets that occupiers want. So I think that the idea that that cost is going to stop occupiers going there is slightly ridiculous. But I do think you will see a lot of variation by geography. And that's why, more than ever, it's important to understand the dynamics of particular markets and start to use some of that data that we've now got available on how people use cities, use streets, use buildings. And using that to understand the investment quality of particular locations is a real theme for us, I think, as an industry. And investing in data and data scientists is more paramount than ever. The main focus, though, and the real spotlight for this year will be on the big six, so the major cities outside London. I think they'll be equally resilient as London, but look at where they are now. The public realm is much improved. Far more graduates are staying in cities like Manchester and Birmingham. And also, they look very good value for money compared to London, I think, in many ways. For the right positions, obviously, you don't have the same access to that international talent pool in many ways. But the real reason why they'll be in the spotlight is the mayoral elections. Will Andy Street, the ex-boss of John Lewis, will he become the boss of Brum? Will Andy Burnham resurrect his political career in Manchester? This will be an important headline, perhaps not knocking Brexit off the top, but certainly on the front page. And that's going to put a spotlight on regional policy. This government is very interested in the idea of rebalancing the economy away from London, trying to introduce measures that will try and boost the Northern powerhouse, the Midlands engine. And it seems rather more convinced about that than perhaps the previous administration. So that's one factor. The other thing as well, of course, is public sector consolidation and expansion probably as well, because Brexit is a huge task for the civil service, and I think there will be vested interest in that growth taking place outside the capital. Moving on, the weak pound. So far, it's been a real positive, I think, for our industry. London hotels have benefited. London retail we've seen doing very well. Leisure. Private overseas investors have held up many of our markets over the second half of the year, particularly in the West End and at smaller lot sizes. We should probably see a growth in staycations over the year, which will be a further boon to the hotel industry. But the one certainty this year, I think, of a couple of certainties that I can probably hang my hat on, is that inflation is going to go up. We'll see the negative side effects of the weak pound really start to come through, going up to 3 or 4%. I mean, that's not that high if you look at the big historical time series, but it will have an effect on consumers. And it could go even higher, I think, if oil prices start to go up as a result of OPEC strangling supply. And that's going to impact on retail. It's going to impact on fuel costs, and that's obviously an issue for logistics operators, manufacturers. And it will also affect construction as well. But I think for our industry, it's retail that I think could be in the spotlight. It's going to impact on retailers' margins, consumers' ability to spend. But there is lots of evidence out there, and we can look at that for several recessions now and several different economic circumstances, that whatever the mood music, spending on destination, retail and leisure tends to hold up very well. People tend to ration their shopping trips towards that destination, that experiential visit. And they also want to maintain that visit to a casual dining restaurant every couple of weeks. So, and they also tend to use the internet more to search for bargains rather than using the sort of more familiar local shops. So I think it will accelerate what the themes we've already seen in retail, which is that polarization between convenience and destination, and also the shift to online, which, you know, of course, the UK is in the forefront of around the world in many ways. This means that retail landlords will have to focus ever more on the experience of their offer, what they're offering customers as a destination, which will be reflected in areas like investment in food and beverage, and also other sort of events and so on that can really draw people in and make it a day out for families. And that split, I think, will be reflected in rental performance and also in yields. The sector that will benefit most, though, from that trend, and I'm sure this is not a controversial point, will be logistics. Companies like Amazon are struggling to keep up with demand for their services, while at the same time other retailers are trying still, in many cases, to work out how they can hone their supply chain to be able to service online customers. And I think with limited supply, that strong demand and a restricted pipeline, that sector will carry on booming in 2017. The highest returns of any conventional sector, and I think investor interest will remain very strong. One area to watch, though, I think, is what the moves over the customs union do to demand for logistics in particular locations. That's one to watch, I think, in the longer term. Arguably, though, the most serious issue for the country as a whole was inflation in construction costs. I think we'll see labour costs go up. Labour may become more scarce. If the pounds become weaker, then it's not as good an option for a Polish worker to come here. He's not going to earn as much in his home currency. But more importantly, materials costs will go up, and it will particularly impact on areas like residential towers and larger office buildings, which are more dependent on imported materials. And that's going to affect viability. In some ways, that's a good thing. It will keep supply limited in many of our markets, stop vacancy rates going up, protect rents, etc. But it's storing up problems in the longer term, particularly in the housing market, I think, and I'll come back to that in a second. But also, it means that when we get to 2019, 2020, if confidence holds up, as I suspect it will, then we'll be facing markets with a supply shortage. What this will do in the short term, though, particularly in residential, where we've seen a lot of interest here from the government, is a shift towards innovative methods of construction, off-site construction in particular. That's not going to help the skills crisis that was identified so succinctly by Mark Farmer in this year's report, which is a massive issue, chronic issue for the industry. But it will help boost areas like the private rented sector and build to rent, which is becoming more important. We've seen Legal & General invest in an off-site manufacturing facility up in Yorkshire. And that will be a big story of this year as well. Moving on to the investment market generally, I think this is really going to be a year in which we see the story of prime and secondary behaving in very different ways. And to some extent, I mean that in a very conventional way, the way we think about prime and secondary, but I also mean something rather different, a distinction between those markets which have robust occupier demand from a varied degree of sources, which are the sort of places that people want to be in, and they may not be conventional prime markets, and also those markets which perhaps struggle a bit more. And that polarization will be a theme throughout the year. It doesn't matter whether you're in London offices or student accommodation. I think you'll see a similar pattern. Bear in mind that UK yields now look quite high compared to many centres, certainly on the continent. And at the same time, we are seeing money move away, and there's good headlines in the press yesterday about this, moving away from bonds and gilts and equities rather, into property because of the higher yields, the illiquidity premium as it's called. I do think, though, that anxiety of a Brexit and inflation and gilt yields, swap rates, debt costs in a Trumpian world will mean there's a flight to prime. But I think those who are brave enough and look for those opportunities in the secondary market in markets that are otherwise very strong and very attractive to occupiers. That's the real opportunity over the next year. Having said that, I think debt might be more problematic for some of those assets. While I think it will remain relatively cheap, we might see a slight tick upwards in overall costs. It will be harder to come by. More stringent criteria will be applied. But that increased weighting that we've seen, the resilience in the leasing market, should mean that we will end up with overall volumes at between 45 and 50 billion over the year. So it will be in line with the 10-year average, not as great as the 2014, 2015 levels, but certainly a market that's been quite robust. Just to finish off, though, central London residential. It's had a very difficult few years, mainly hit by the tax changes, the stamp duty changes that the government introduced. We've seen some markets suffer quite badly. This year, I think some of that will start to stop being such a problem, but I don't expect to see anything more than flat price growth in that market. I also expect to see construction volumes fall back quite rapidly. You can see that already happening in terms of construction starts. There'll be a stronger story outside central London. The mortgage market's quite buoyant still. The figures seem to be quite positive. It's more affordable, especially when you get outside London. And at the same time, we're going to see that explosion's perhaps a bit of an exaggeration. We're going to see much stronger activity in the whole build-to-rent market. It's where the institutions want to be. There's funds being set up for that market the whole time. And we are starting to see real activity there, especially in London and some of the regional centres. I also think that the cities that I mentioned earlier, the likes of Manchester, Birmingham, and a few other centres around the country, will do very well off the back of the growth that I mentioned earlier, the spotlight from the mayoral elections, to focus on those cities more generally. So I expect very, very low single-figure growth for residential markets outside London, perhaps slightly higher in centres like Manchester, and flat in central London. The government, though, will be very, very focused on trying to improve housing supply. I think they see that as being at the core of some of those issues that the Brexit vote highlighted, the divide between north and south, between rich and poor, between the affluent, the haves and the have-nots. We're going to see a white paper in a few weeks, if not days. That will have great effects in the longer term, but don't expect a step change in the short term. But I do expect fireworks as Conservative rural MPs start to twig some of the radical measures in the white paper. Just to finish off, politics is going to stay interesting and relevant throughout the whole year. And Twitter, I think, will certainly stay interesting with Trump in the White House. The question for me, though, is what this all means. Trump's policies are very hard to interpret, very hard to ascertain. Will it be more protectionist? Will the dominant theme of Trump's stay in the White House be one of a booming economy, a stimulated economy, or will it be one of closing the walls around corporate America, around working class America? If the US is more closed, but at the same time we have a better special relationship, which we've just seen Boris over there trying to mend the fences with the Trump administration, could that help the UK attract more investment? Could it re-emerge as a safe haven, particularly if we have more problems on the continent? At the same time, China appears to have avoided a hard landing, but it appears to be becoming more protectionist too. So I think there are lots of opportunities for the UK in that world. And I think the most likely effect for our markets of the Trump presidency will be upward in pressure on inflation and resulting impacts on areas like gilts and risk-free return, and that will have potentially an impact on yields. However, I think if you look at history for the UK market, where we've had robust demand and rents have remained generally robust despite what's happening in the wider economy, then volumes can hold up and yields can hold up, and I think that will be very much the story of the year. Just thinking about the politics domestic, though, finishing off, we know very little about what this all means, I think, in the UK still as well, apart from Brexit means Brexit. So I think to sum up, 2017, I think, means perhaps 2016, a similar roller coaster ride, similar wailing and gnashing of teeth at various points in the year. But ultimately, I think throughout that, our markets will show a similar pattern to 2016, surprisingly resilient. Thank you very much.